Hey everybody, Todd Seymour. Thanks so much for checking out the video on the best ways to save for retirement. And as always, not trying to give you any types of opinions. Sometimes I do, but I'm mostly trying to make you think differently. And today we're going to talk a little bit about what's a pretty complicated subject is retirement because there's so many types of plans. And to be honest with you, that's usually the reason why this is a little bit complicated. So let's talk about common plans and then advantages and disadvantages. How's that? So first one is going to be what to me the more popular are like 401ks. If you're like a teacher or nurse, 403bs, 457s, those kind of all that kind of stuff. These are basically non-for-profit. That's why they're different code section. And then these are obviously for-profit. But the similarity on the scheme of the plan is that they are payroll deferred. And it's amazing to me how many people have these options and don't take advantage of it. As a person with a tax and a finance background, it makes absolutely no sense because typically these are employer matched, and that's free money, right? A lot of times, let's say it's 1 to 3%. I know in many cases it's even higher than that. So let me give you my example of why I get frustrated that people don't take advantage of these plans. Because let's just say you made 50,000, which puts you in a 12% tax bracket. And you're lucky enough, or you've thought about it enough, where you can put 10% deferral away, which makes our net wages 45,000. And so this is our W-2 box 1. And that's what we're paying tax on, is that 45. So think about why I get frustrated is, so I've got, people will come back to me on the 401ks or any type of retirement plans and say, there's risk in it, or I don't have the money. And, I'm not saying you need to put 10%, but at least without a doubt, you should definitely do up to what you match. It's free money. But think about this. If I can put the 5,000 away, let's look at everything in life is about what am I going to get out of it, or rate of return. So ROR, rate of return. I'm going to get 12% guaranteed tax savings. So that's a rate of return. I'm going to get money back when I file my taxes in April of 12% of whatever I put in. So in this case, I'm going to get $600 back. Automatically, let's call it my 3% match. So these two are guaranteed, right? And I'm also going to get an investment return, not guaranteed, but let's just even say conservatively 5%. And so immediately I'm going to get 20%, right? So that's a 20% rate of return where 15% of it is guaranteed. If you think about it now, maybe you don't understand why I get frustrated. It's like these two right here are guaranteed. So even if the market doesn't make any money, I'm still getting 15% back on my money. And I'm also going to get a $600 check from the government, which is awesome. And that's what you have to remember is many people don't understand when they're doing 401ks or 403bs and et cetera, is that I'm only paying my W-2. It's kind of nice. Even though I made 50 gross, I'm only paying tax on the 45. The 5,000 defers tax until you take money out down the road. So it's tax deferred. The only other thing I can think of with these types of plans is that many teachers have annuities as an option in their 403b. So that's an absolute no. And there's somebody that works at your school that handles your 403b or that comes in and gives meetings or whatever. Do not put an annuity inside a retirement plan. Okay, you're much, much better off by taking the investment piece of that 403b or 457. Usually teachers can pick either one. It doesn't matter, to be honest with you. They both usually have the same type of selections. And you got to review your investments. So investments are what we're looking for. And by that, it's usually mutual funds or what's called ETFs. And those are going to do much better than the annuities. You never put an annuity inside a tax-deferred vehicle anyway. So second thing, and most common, are IRAs. And many of you know, and this is some of the things that I wanted to talk about today, is that there's traditional, which is the most common, but becoming very popular, are Roth IRAs. So the difference between these two is one, limit or contribution amount. So 401ks, depending on age, I'm just going to put the general, you can put 19,000. IRAs, you can put 6,000. And so can you do both? Depends on income and many other things. So a lot of times when we do taxes, if clients aren't taking the full advantage for the 401k, then we can always, since this is a calendar year plan, we can always do a little bit more when we're filing the tax return. You can give different scenarios. Like if you did 1,000, this is what you'd get back. If you did 2, and so forth. So the 401ks, what are the differences between these two? Is that a traditional is tax deferred, which means that we don't pay tax until we take it, but we get a tax deduction today. And so younger people really like these 401ks because it's tax-free and no tax deduction. And again, everybody's different. I'm just giving you my 2 cents. So which one is better? Well, it depends on a multitude of things, obviously. They both can invest in the same thing. They both work the exact same way, except for these 2 things. So we'll just put a 1 and a 2 so you can see the difference. The thing I like people to think about is, remember with this tax deferred, we want to look at what tax bracket we're in now versus retirement. And here's what I mean to make you, again, think differently. Not that I'm right or wrong, but let's say today I make decent money and today I'm in a 25% bracket and I'm going to put my 6,000 into that. So I'm going to get a tax credit today of $1,500. If I want to, I can even take that and put it into a Roth, right? So I could put 7,500 technically, one in 1 year, one in another. Remember, these are per year that you can do. But I'm going to get a check back, just like I did my 401k, of the $600 here. So I'm going to get a check back of 25%, depending on that's my bracket. Let's say when I retire, I'm only in the 10 to 12% bracket, which is pretty common for many of my clients. They are in that bracket because remember that wages are taxed at your what's called ordinary tax rate. So whatever tax bracket you're in, that's how wages get taxed. But investment income is taxed at all different types of rates. And that's why, all joking aside, when people say, yeah, taxes are easy today with, all the new planning, it's simply not the case because every line item is taxed different. So think about it. Wages are taxed differently than interest, is taxed differently than dividends, is taxed differently than capital gains, is taxed differently than Social Security, and you can keep going. Why they make it more complicated, maybe it's job security for tax preparers, I don't know. But that's beside the point. I moved, when I retired, or when I worked, I was in 25%, and now I'm here. So $1 today is worth more than $1 tomorrow. It's the first thing you learn in finance class. And if I can guarantee, so we talked about rate of return here being 20%, even though this is a much better way, the 401k, because of the payroll deferred and because of the match, If you don't have that opportunity, that's why we're talking about IRAs. If your employer doesn't offer it, then this is the rate of return is an immediate guaranteed 25% or whatever your bracket you're in. This one I used a 12%. So even if I'm in a 12% bracket, I'm still getting a guaranteed 12%. And that's how you have to look at anything when it comes to doing retirement plans, is that you're automatically getting a rate of return of your tax bracket. First and foremost, if you get a match, that's even better. If you get investment growth because of that, because of the economy, that's even better. But worst case scenario, so if we look at everything worst case scenario and we can deal with that, worst case scenario is I'm getting my tax bracket back on whatever I put into these investments. That's what you have to think about. So the reason why I like traditional over a Roth is because if I'm making more money today and I'm making less money down the road, I'd rather take the tax advantage at a higher bracket than a lower bracket. That being said, let's say I'm in a 10 to 12% bracket today, and when I retire, I'm going to be in the same bracket. Well, then maybe a Roth is better. But again, today's conversation is just about making you think differently. That's all. Everybody that I usually deal with or are coming to talks with, especially my younger clients, they're always looking at the Roth. And when I show them the difference on the traditional, it just makes them look at it a different way. So the last type of plans that are out there are, I'll call them other plans. And that's things like SEP IRAs, KEOs, all those other types of plans. And those are usually for self-employed people. So individuals can do these types of things, but the one thing, the reason why we're not talking too much about the SEP IRAs and those types of plans are because there's something new and better. And with tax law, things change all the time. I'm coming into, my 27th tax season. And, when I talk about these traditional IRAs versus Roth, clients would say, the reason why I don't want to do the traditional is because taxes are going to decrease later on. Well, they could. And you're going to learn that when you deal with money that you plan for the now. So I know today that that's what the tax bracket is. And I know that that's the tax bracket today when people retire. So that's how I plan. In all my years of doing this, taxes don't go up. They usually either stay the same or decrease. And if they go up, it's usually tweaks in certain types of areas. So plan for the now. That makes things easier. So on a SEP, this is the reason why. So we got 56,000 was our cap that we could do on a SEP. And if we're self-employed, which many of my clients are, some of my clients that are getting great cash flow or like real estate agents or people that have money coming in or are trying to figure out how to put money away into tax deferment, get a tax deduction, and so forth. So when you're doing a SEP IRA, it's only the employer that is able to deduct it. So the employer could put away in a SEP $56,000. In today's world, there's a newer plan that's called a solo or I-401k. And the beauty of that is you can put the employer of 56,000 plus the employee of, in today's world, 19,000. And so, if we're making great money, we're trying to do the best we can tax advantage wise. And a solo 401k over a SEP IRA just offers many more pros than cons. So remember, I've told you before, in every investment, there's a pro and con. There's the downfall maybe on a solo 401k is once you hit 250,000, then you have to file what's called a 5500 tax form. And my comeback to that is who cares? You're just telling the IRS, this is my plan that I set up. Here's my investments. That's it. I mean, there's no tax due on it. It's just a reporting requirement once the plan gets to 250,000. But obviously, to be able to push 19,000 more into retirement and to take a tax advantage on that is such a big pro. So all different kinds of plans. You could see where there used to be just one publication that would cover some of these areas. Now there's multiple publications, so it gets super confusing. The biggest thing is to, when you meet with your tax preparer, is to figure out where you're at tax-wise, to figure out where you are with your cash flow from your business or from yourself, and see if you have what's called discretionary or leftover money that you can possibly put away in some of these plans that will help you out tax-wise. I leave you with, I think you would agree, you would rather save for yourself than give the money to the government. So when we have leftover or discretionary money, especially in our business, we're either going to pay ourselves or we're going to pay Uncle Sam. And so if we can show you ways to save money and save for yourself, it's a win-win. And any other questions, feedback, follow-up, as always, I'd love to hear it at taxandtrusthelp@gmail.com. Thank you so much for spending time with us as usual, and we look forward to talking to you soon.